welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today we've got another investment video for you. Apologies, this has taken quite some time. Originally, Freetrade were late with this, and then I was late, and then I was waiting for them to do this week's, and then I realized they're not doing one this week because I was going to merge the two together. So it all just became a bit of a mess. But today I'm going to do Freetrade's new top 25 stocks, which came out not the Friday just gone, but the Friday before that. So I'm going to give you my take on some of the stocks, ETFs and REITs that have now been launched. And obviously it's for you guys to, do your own research on whether or not you think this is going to be good investments for your portfolio. So if you want to know more, please like, please comment, please subscribe. On a mission to hit 2,000 subscribers and get the world of investing out to more people in a clear, simple and transparent manner. But first, let's get into this. I'm going to put this into the spreadsheet that I leave into the description. This is on my own personal one at the moment, but don't worry, it will be there by the time you're watching this video. And the ones that were launched, not last Friday, but the Friday before, you will see new 8, and that they are Abcam, RWS Holdings, Secure Income REIT, Clinigen Group, Blue Prism Group, GB Group, Keyword Studios, Breeden Group, Gamma Communications, Hurricane Energy, First Derivatives, Highland Gold Mining, Biffa 2, Merchants Investment Trust, NB Global, Civitas Social, Chemring Group, Chesnara, Standard Life Private Equity Trust, Morgan Sindall Group PLC, JPJ Group, Scottish American Investment Co PLC, Picton Property Income Limited, DFS Furniture, good old DFS, and Bailey Clifford Shin Nippon PLC, bloody heck. And we had some 3 ETFs, which was the iShares Aging Population UCITS ETF, the iShares Edge MSCI World Momentum Factor UCITS ETF, the iShares S&P Small Cap 600 UCITS ETF. So what I normally do, if there's ones I want to potentially look forward to investing into and look, a bit further, I put into a pending status. But I've actually put none of these into a pending status just because there's nothing there that personally I want to add to my investment portfolio for a number of reasons. But there are a few ones to talk about. So I'm going to be going through some that I think are very, very interesting, and it might be worth for you guys to have a look. So the first one I'm going to talk about is New River REIT. So New River REIT is a leading real estate investment trust specializing in buying, managing, developing and recycling convenience-led, community-focused retail and leisure assets throughout the UK. The last earnings update was blah, 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 blah. You can see from the graph, slightly tailed off, but it seems like it's picking back up. It's just cool. Their last year returns was minus 24.4. So, me personally, that for me is a little bit of a cause for concern. There might be some, issues there of why the REIT is losing favor among investors. I think that is probably contributing to the fact that it looks very, very undervalued. But again, you have to sometimes take the undervalued status with a little bit of a pinch of salt, because it can be a positive as well as a negative depending on, the stock in question. No ratios, you can't really see in terms of its value. It's saying that the future performance growth is 97.8, which is astronomical. I think that's probably just a byproduct of the fact that the stock is falling, and it's a little bit on the depressed side. So if I go to that full view, which I do by doing, can't remember how to do it now. No, I'm just zooming in now. Anyway, when it goes to the full view that you saw before and it's sort of dropping here, that could be partially the reason why there's an expectation of such a high growth, but also it's only from 4 analysts. I genuinely like to see something in the region of at least 9 upwards, but if it's in double figures, then, the more the merrier for me, personally speaking. When you look at the balance sheet, obviously it's got a lot of physical assets because it's a REIT, so 1.28 billion worth of physical assets. It's got a bit of debt at 503 million. And when you can look at the sort of trajectory of the cash flow, the net worth and the debt, what we're seeing is the net worth is increasing, but it seems like the debt is also increasing in line with the net worth, but it's still maintaining the same amount of variance roughly. So it's not that bad, but it's still got rising debt, which can be a cause for concern. There might be something that they're doing that's causing that to be the case. But for you dividend investors, you might like to see the fact that it's got an 11.33% yield. Now, you need to watch my video on dividends if you haven't watched it. Sometimes don't be attracted to such a high yield. A high yield can also be a negative thing as well. Because the stock is again falling. So we all know that yield is in relation to share price. So it's the dividend per share divided by the current share price at the moment. Now, if the current share price keeps on falling, then that yield figure is going to go up. And if the current share price starts rising, then that yield figure is going to go down. This yield figure is out of date at this very second because it always changes depending on what the share price is. But they are paying their next dividend, or it's going X in 8 days. So if you did think this was attractive, then you've got 8 days to invest and you will get your next payment in 36 days, which, might be interesting for you. So yeah, that's one thing I wanted to call out. The next one on the list to call out is Hurricane Energy. Now, this for me is something to potentially watch out for. And it's just watching out for companies that display these types of, characteristics. So again, if we look at the last year return, minus 29.4%. The whole industry didn't do well at 11.1% minus. But obviously this, excelled itself at, outperforming the industry, negatively speaking, and, being quite a depressed performance. Now, here, look at this. Its valuation is 41p is the current share price at the moment, and is expected to go down to 1p. So people often on Freetrade, and probably on all investment platforms, but one thing I'm noticing as a trend, and I'm probably going to do a video on it, is that just because something's cheap, it doesn't mean it's valuable. Just because a share price feels expensive, let's say it's £100, £200, it doesn't actually mean it's expensive. Value and share price have no correlation whatsoever. You can have a 40p share price and it be very expensive for what you're buying. The same way you could have a £50 share price and it could be very cheap for what you're buying. There's other factors to basically look at. The share price metric is basically arbitrary. So this is an example where, there'll be people that might see this on Freetrade, say it's 41p, I might have a punt. And for me, fundamentals wise, yeah, I would definitely watch out for this. There's no ratios that you can see. Future performance 22.3, that's predicted. And then when you scroll down, you're seeing that the debt is actually not too bad, to be fair. They've got a lot of physical assets. And you can see actually the cash flow, the net worth is rising, which is good. Cash flow is slightly going down. The debt is slightly starting to increase, but it has maintained for about 2 years. So, maybe they've got a handle of things there. So it'll be interesting just to find out, what's really going on and what the future outlook for the company. Again, when I do this review, this is purely the first level of analysis, just to kind of see if I like the flavor of a company before I do a bit more deeper diving into what the company is actually doing, some of the challenges they're facing, competitors, threats, opportunities, products, blah, 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 blah. So this is just to kind of really understand the fundamentals and see whether it's worth it. But, based on this, it's actually not too bad. And this doesn't actually pay a dividend. But yeah, this type of stock for me, based not only just of the valuations and the fact that there's no, and based off its previous performance, it's just one of those things that, irrespective of its current share price, is something to potentially watch out for. So just be careful and beware of things like this. It might turn out to be good, who knows, but that's my personal take on it. The next one is Merchants Trust. Now, Simply Wall Street is not great for ETFs, investment trusts, or any types of funds. It doesn't really have that much information. It just has some of the basic information, but that's pretty much it. Looks a bit undervalued. Again, it's not really clear how much you can kind of take that. But the only reason why I called it out is because a lot of you guys are dividend investors. Obviously, being a good fund, there's no debt whatsoever within this fund, and it pays a solid dividend of 5.73%. So if you just wanted a solid dividend payer, if you look at the last year, it only fell minus 1.2%. then it looks like your capital will potentially be preserved. You might not make that much money, but you'll make it up in, your dividend return of 5.73% a year alone. So this is something for you dividend investors out there that, you feel might be interesting. Some of these funds actually might be some of the easiest ways in order to try and start achieving your dividend related goals. So it's worth looking into if you think that's going to be interesting. The next one is Civitas Social Housing. So Civitas Social Housing PLC is the first real estate investment trust, REIT, dedicated to investing exclusively into existing portfolios of built social homes in England and Wales. Now, when we look at this, the market cap's 529, and we can see again the graph is slightly tailing off. So it's losing momentum over the course of the year, and it's starting to go down. And there could be a very, very important reason for that. We're seeing the 1 year return minus 21.7, as you can see. But sometimes when you look at the 3 and 5 year, you can actually see that there's no 3 and 5 year for this. So it seems like it's potentially a new REIT. Sometimes when it's potentially new REITs and ETFs, it takes a few years to bed in. And once they find their strategy and find their footing, it actually starts to work a little bit well. Maybe some of the higher drive at the beginning was just due to marketing and so forth, but now it might actually start to rise based off its actual fundamentals. So that could be something to potentially look out for. In terms of its value status, it looks about even, and sometimes it's better seeing things like that. It's got some ratios, and the one I like to look for is PEG and price based off assets, when it's a company that has a lot of assets, which obviously REITs would. So in both of those two, they're doing exceptionally well at 0.8 and 0.4 as a multiple. So if you want to know what these means, I've got a video on both this and this and this, and other stuff in the fundamental series. So go and check that out. Link will be in the description, and you can find out what they mean and how to evaluate it and how to, apply these numbers to you. And also, even if you don't have Simply Wall Street, these numbers are going to be available on Yahoo Finance, on Financial Times, in most places, Morningstar, and it'll be for free. So you don't have to pay for that. In terms of future performance, it's 5-star rated, which is really good. 46.1% in terms of future performance. So there might be a good turning around with this specific REIT, which is one of the reasons why I wanted to call it out. The balance sheet obviously is looking healthy AF, which is fantastic. And there is a gradual, it is still a fairly new REIT, as I alluded to earlier, only been running for a couple of years. There is a gradual incline in debt, but it seems like there's a high incline in net worth. But this cash falling is a little bit interesting. Again, it's a very short period of time, so there must be, something's going on there which I don't know about. So, be more investigation would definitely be needed. But as a new REIT, there could be some potential in this in the future. This could be actually something worth looking into. Typically, I'm still not going to add it to a pending status purely because I've got too many stocks now. And I need to go on a consolidation exercise. But that's me personally. Some people feel that they need to have 30, 50, 60, 80, 90, 100 stocks, whatever. So, if you feel differently to me, then absolutely potentially look into this one. Civitas Social Housing, it might be something that's worthwhile. But from a dividend perspective, it's 5.97%, and it's expected to be 6.35% next year. It's not going to have a lot of the dividend metrics just because it's not going to be paying out for 10 years because it hasn't been going on for that long. It's only been paying out for the past 2 years because it's a brand new REIT as well. At the moment, it says it's not well covered by earnings, 0.8 times, but dividends after 3 years are expected to be covered by earnings, which is good. So the forecast of it is good. It's just not doing that at this current juncture. However, we know with REITs, they have to pay at a minimum of 90% back to shareholders. I just received a dividend today from Landsec, I think it was. I think they paid 100% or 98 or something ridiculous back to shareholders. So REITs are definitely things I think are worth getting into. 1, you're in the property market. 2, you're always going to get a regular, consistent dividend. And 3, they have to pay you out, so it's not just going to all of a sudden disappear. And if they're managed well, it could be an opportunity. So yeah, look out for that. Civitas Social Housing number 5, Chesnara. Hopefully I'm pronouncing that right. That's an insurance company. Definitely not adding this just because I've got 2 insurance companies in my portfolio and I really want to consolidate into one. We're seeing again that the graph is starting to dip. Now, a lot of these stocks are AIM stocks, I think. Now, this is on the LSE. This might not be AIM, actually. But you can see the last year returns, minus 23.1. Again, not too great. See, I hold Aviva and Legal in general. So me personally, I'm not going to add this. But it's got some good fundamentals. Undervalued to an extent, which looks decent. No ratios at the moment. Actually, this is something to watch out for. Minus 23.4% in terms of its future performance. So there's definitely a massive concern when it's dropping down like this and the future performance outlook is a loss of quarter of the business in terms of revenue or earnings. So that's something to, definitely watch out for. In terms of debt, however, though, it's got no debt whatsoever, which is really good, or very, 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 very low level of debt, which is fantastic. It seems to have a lot of cash, which again is fantastic, but the net worth for some reason is quite low. But it's really weird. The future outlook is quite low. This is quite an interesting one. The future outlook is quite low. It seems a bit undervalued, but the balance sheet in terms of its capital and in terms of its debt and blah de blah is decent. It's very, very decent, but it's interesting. So it's definitely something worth looking into a little bit more. And it pays a very strong dividend at 7.66%, which is expected to rise. Not only that, when you actually look at some of the other dividend metrics, they've been stable in the past 10 years. They've increased over the past 10 years, which is what, a lot of dividend investors look for, that they're stable, that they increase. They're covered by earnings by 1.8 times. They just don't know if it's going to be covered by earnings after 3 years. And that may or may not be a concern. It depends on your horizon. So, there are some elements of this which is like, sign me up. And there's other elements of this which is like, stay away from me. So it's definitely an interesting one worth looking into. I don't know if this is an AIM stock. Most of them typically say, so Hurricane is an AIM stock. It'll say AIM. So this is obviously not. But a lot of these stocks that Freetrade are adding now, some of them are lower liquidity, some of them are a bit higher risk. So, you have to do a little bit more due diligence than say when you're buying a Barclays or Lloyds, because it's a Barclays or Lloyds. Do you know what I mean? It's a mega cap company. You trust it. You can see it every day. When you're buying Chesnaras, you don't see Chesnaras every day, right? So you have to just, do a little bit more of a due diligence when you're purchasing some of these items. The last one on the list is Morgan Sindall Group. Morgan Sindall Group PLC operates as a construction and regeneration company in the United Kingdom. The graph has been pretty volatile, but actually some of these types of graphs I actually kind of prefer because it's not just trending downwards, which is good. There's obviously some volatility. There's movement. They could be doing the right thing. It all kind of depends really on a whole bunch of factors. See, the last year return minus 9%, so something to bear in mind. Seems pretty undervalued, but that might be due to the fact that it's started to tail off down a little bit. Ratios are looking decent though, 1.3 times, 1.5 times. Now you got two X's here because typically they want to see it to be under one or under, but I just find that unless they're real big banks or insurance companies, sometimes, or finance companies or mining companies, sometimes you'll find it hard pressed to really get it under one. So I'm lenient to an extent with some of these ratios because they're just different ways of trying to calculate the value and the worth of a stock. Future performance, pretty tame at 5.9%. And then we scroll down to the balance sheet and we look at the balance sheet and we see that the balance sheet is very, very healthy. Obviously, they've got a high level of assets in inventory, which is fine. You can kind of expect that with a company that's capital goods and does construction and so forth. So yeah, they're gonna have inventory as well, cranes and all kinds of stuff. But the balance sheet is looking good. You see that the debt is tailing down, which is the trend I want to see. I want to see the red line going down. That's me personally, because I know that if a company has more cash in the bank, then they can reinvest back into the business or they can pay out in dividends. which for me as an investor is quite important. So we're seeing the net worth grow, we're seeing the cash grow, but it's having these weird little peaks and troughs. But we're seeing the debt decline, which I think is a great news story as well. And last but not least, it pays a 4.53% dividend, and it goes ex-div in 1 day. So you got 1 day in order to invest if you want to take advantage of the next dividend payment within 18 days. I do like to cut it fine when telling you, but hey, this is the situation. Do you know what I mean? So dividends have increased over the past 10 years, but they have been volatile over the past 10 years as well. Wait, the annual drop of over 20%. I have to double check because that feels contradictory. I'll double check that. I'll let you know in the comments if there's anything there to be worried about. But they're well covered by earnings and expected to be well covered by earnings over the next 3 years as well. Let me just see what the investment spread. Okay, so they're 79% invested by institutions. I like companies that have a larger institution investment holding, I don't know, register, so to speak, than just mainly general public. That for me is a better sign, and I've got a video on that and my reasons why as well. So yeah, this could be quite interesting actually. You know what, if I had less stocks, maybe I could be putting Morgan Sindall Group into a pending status actually, to be honest. I think I would potentially, chuck a little change at this one and, see what happens over the short to medium term. So this could be something pretty interesting to look into if you want to look into it. So those are that in terms of the stocks. In terms of the ETFs, for me, the 3 ETFs in question: aging population, which is basically investing in companies that are doing products targeted at 60 to 90-year-olds or something like that. Not for me. Momentum factor, which is, I think, momentum stocks or something like that. Not for me. I had a quick look at some of them about 3 or 4 days ago when I actually did the spreadsheet, and I was like, none of them are for me. And the small cap 600, again, is not for me as well. So they might be for you though, so definitely go check those out. If you want to check out any of these and you're thinking, you know what, where do I get the good information on any of these ETFs? My recommendation to you would be to start off with this website, justetf.com. And then, for example, if you were looking at ages, which is the aging population, you can just start there. You can click on that, and you can find out, what's their returns been like, which can give you an idea. You can find out an overview. You can see the chart. You can get the key and information document, what's been going on. All of the documents are here. I would start there, and then I would potentially go to iShares website. And I think when you go to the iShares website, you will be able to just search ages here. And when you search ages, you've got the aging population right there. And that's a way to look a bit more, find out some of the holdings, etc., etc. So if you want to see all of the holdings, it tells you it's got, 0.52% in Alder Biopharmaceuticals, 0.43% in Novacure, etc. Probably going to have a lot of healthcare stuff actually, which makes sense if it's about aging population. So that's the type of thing I would start to look through when it's ETFs. I wouldn't really look into simply Wall Street. So yeah, if you want to know that, that's what I potentially would do. And hopefully you found this information useful. If you did, please like, please comment, please subscribe, please share the video as well. Help this video get out to more people. And obviously, if you want videos on any other investment related topics, if you think there's things that I'm not covering, you're like, Curtis, man, like, I like the channel, but you're not talking about boom, boom, boom. You let me know in the comments what boom, boom, boom is, and I will make sure that I sort that out in the short to medium term. No, I'm joking. I'll sort it out soon enough. So just leave it in the comments and we can talk about whatever it is you want me to create a video for. Other than that, take care, like, comment and subscribe, and I'll catch you next time with another investment video. Peace.